Alright, so this is the second video in our introduction series, and we're going to talk a little bit about call options. Now, if you have not subscribed to our series, if you're just coming to this video for the first time, we've already covered in a prior article, the basic nature of the underlying option in terms of the fact that it's a contract and that call options give the purchaser of the contract a right to buy stock, and a purchaser of a put option will have the right to sell stock. Well, what we're going to do today is we're just going to look at kind of the risk profile of a call option, and we're going to talk a little bit about the practical implications that exist for someone who buys an option. So what we're going to do is we're going to assume that we're going to buy an option on the Spider, which the market's actually closed, but it's closed at 139.35. We're going to buy the at-the-money call option, which is the 139 call, and we're going to buy it in the September expiration, okay, as opposed to the August. And the reason is because with August you only had the 15 days till expiration. September gives us a little bit more time, and as we discussed in the article, time is very significant when you're buying or selling options. And when you buy an option, you want to give yourself enough time so that the underlying stock or security can make the required price move to put you into profitability. So we're just going to purchase one call option, and we're going to analyze this trade. And we'll zoom out just a little bit. And this is our basic risk graph here. Now I'm going to expand the window here just a tad. And okay, and so that should give us a little bit better view of things here. So what we've got is we've got this basic hockey stick risk graph, and what it represents is that this expiration line here that represents a maximum loss, which is $317. That's the most we can possibly lose. Now, if we bought 100 shares of the Spider at $139, you'd have $13,900 in actual risk. But with a call option, we're only going out of pocket $300. That's our risk. No matter what happens, that's the most we can possibly lose on the trade, which is a real nice feature. Now, because we have time value or extrinsic value in an option, we need a price move to occur in our favor. In other words, we need the Spider to move higher, and we need it to happen before the expiration date is reached. If we don't get that price move, then what happens is the value of this option starts eroding and starts kind of collapsing towards this expiration curve. Now, a downward price move, you're going to see the price slide right down there, and by the time you reach down here to 127.48, it doesn't really matter how much time is left. You're so far out of the money now that you basically have a worthless call option. But if we're going to make some money on this transaction, on this trade, what we need the Spider to move higher, and we need to do it in a fairly short period of time. In this case, within 50 days. But if we can get that price move, then you can see that we don't need to make a lot of money to have a very significant yield. So here, if we get up to this $200 profit level, because we've only invested $317, we've got a 63% yield. Now this purple line represents a 1 standard deviation move. And what that means is that a little over 68% of all price outcomes from a statistical point of view will occur within this purple range. So this is a very reasonable range. Anything that we look at inside this range has a reasonable chance of occurring. And we can look all the way up to $146 per share, and that's a 1 standard deviation move. So if we see 146 by expiration, all right, we're going to be looking at basically over a 100% return on this call option. And 146 the difference between 146 and 139 is, we're only talking 7 points on the spider. Now, if you made 7 points, right, on 100 shares of the spider, that's going to basically translate into $700. But let's just do the math here real quick. If we make $700 and we spent $13,900, that's a 5% yield. But if we make at 137, if we make $400, the dollar return is a little bit lower, but our yield is significantly higher. I mean, the difference between 5% and 130%. So what call options do is they give us the potential to leverage our trades, because we can purchase a call option for a relatively small amount of money. We can capture most of the upward price move in that call option, and we have a very limited risk. So in terms of a trading vehicle, call options are extremely attractive vehicles. They give us quite a bit of leverage. We don't have to risk a whole lot of money, and we don't need extraordinary price moves for those yields to take place. So that's basically the skinny on a call option. Our next video, we're going to focus on a put option. And if you haven't already subscribed, I encourage you to head over to theoptionclub.com, sign up for our free introductory course. All you need to do is plug in your first name and an email address, and we'll run you through the basics of options and how they can be used for purposes of both trading as well as investing. Okay, you guys take care, and I look forward to seeing you on the theoptionclub.com website. Bye.